How do expiration dates affect delta-neutral strategies? Have you ever wondered how expiration dates can change the game for delta-neutral strategies in options trading? Let's break it down in a way that makes sense. Delta-neutral strategies are all about balancing the positive and negative deltas of options and stocks. The goal is to keep the net delta close to zero, which means the position should not react much to small price changes. This allows traders to focus on other factors, like volatility. Now, expiration dates play a big role in how delta behaves. As options get closer to their expiration date, their delta starts to change more quickly with movements in the underlying stock price. This happens because time decay, also known as theta, speeds up. For example, if you have an option that is at the money, its delta will move closer to 1-4 calls or negative 1-4 puts as it approaches expiration. If the option moves out of the money, the delta will drop rapidly towards zero. This means that as expiration nears, traders need to adjust their positions more often to keep that delta-neutral balance. Frequent adjustments are key. When delta changes quickly, traders must rebalance their positions to maintain neutrality. This could mean buying or selling shares of the underlying stock or adjusting the options themselves. If you don't rebalance, you might end up with unexpected directional exposure, which can increase your risk. Another important aspect is the cost of hedging. As expiration approaches, options lose their time value fast. This can impact how much it costs to hedge your position. The rapid delta changes can lead to larger transactions, which can increase your overall costs. Additionally, the risk profile shifts, making the position more sensitive to price movements. If not managed well, this can lead to increased volatility risk. Traders often choose options with different expiration dates based on their goals. Longer-dated options tend to have slower delta changes. This means less frequent adjustments, but they can be more expensive due to their higher time value. On the other hand, shorter-dated options requiring more active management but can respond quickly to short-term volatility changes, which some delta-neutral strategies aim to take advantage of. Lastly, the time left until expiration also affects how volatility impacts your position. Options that are closer to expiration are more sensitive to changes in implied volatility. This can be a double-edged sword, depending on market conditions. In practical terms, if you are using a delta-neutral strategy, keep a close eye on expiration dates. Be ready for increased activity as expiration approaches. The success of your strategy hinges on how well you manage the dynamic nature of delta, which is heavily influenced by time decay and how close you are to expiration.